Good morning, it's Monday the 8th of October and welcome to Atlantic Capital Markets roundup of the coming week's economic highlights to keep an eye out for. As always, we'll give you a quick summary of the macro data points from around the world to expect over the week. We'll then look in more detail at some of the bigger stories straight afterwards. So, stay tuned. So, let's take a look at the economic numbers being issued this week, and starting today we have the OPEC Plus meeting and the US factory orders. And on Tuesday, the global services PMIs, and a big day in Australia. We'll get the Australia interest rate decision, and we'll look at both of these stories in more detail shortly. And also on Tuesday, the EU PPI figures, and over in the US, the ISM non-manufacturing PMI figures. On Wednesday, over in New Zealand, the interest rate decision due, and the Germany factory orders numbers, EU retail sales figures, the US ADP employment change, and the EIA crude oil stock change numbers. On Thursday, we'll get the Germany industrial production numbers, over in the US, the Challenger job cuts and the initial jobless claims, and Canada's Ivy Purchasing Managers Index. On Friday, the China Caixin Services PMI numbers, Germany trade balance, and the latest US non-farm payroll numbers. And the companies that we'll hear updates from this week are as follows. On Tuesday, we'll be hearing from Greggs, and over in the US, PepsiCo, and we'll talk more about these two in a moment. On Wednesday, we'll hear from TESCO and Imperial Brands, and again, we'll discuss both of these two shortly. And also on Wednesday, Constellation Brands and Levi Strauss. On Thursday, we'll hear from Mondi. And on Friday, we'll be hearing from Electro Components and the cruise company CARNIVAL, who we'll talk about more in a moment. So, September, typically a weak month for equities, saw stocks experience a sell-off, a steep sell-off at that. The question is whether investors will be tempted to buy the dip. Concerns over supply chain disruptions, labour market shortages, and how these feed into rising inflation are likely to remain in focus. OPEC Plus will be meeting amid the ongoing energy crisis and could raise output. Meanwhile, both the RBA and the RBNZ will also meet. The US debt ceiling and infrastructure bill will also be under the spotlight ahead of the US non-farm payroll on Friday. So let's take a look at some of this week's key stories in detail. On Tuesday, we'll get the latest interest rate decision from the Reserve Bank of Australia. Now, heading into the last RBA meeting, there was a broad belief that the bank could push back the tapering of bond purchases from 5 billion Australian dollars to 4 billion a week owing to the resurgence of COVID and the various lockdown restrictions. However, this was not the case, and the RBA both tapered but also extended the horizon for tapering until February next year from November this year, previously set out. Heading into this RBA meeting, the economic picture and outlook hasn't changed dramatically given that many pandemic restrictions remain. As a result, it is unlikely that the RBA will take further action this week. Instead, expect a reiteration that the central bank remains supportive and that the economy is expected to recover firmly as vaccine rates improve. So, of course, keep an eye on the Australian dollar. And here in the UK, the flash estimate PMIs for the UK services sector revealed that activity growth in the UK's dominant sector slowed in September to 54.6, down from 55 in August. The data will add to concerns that the UK economy is heading towards stagflation as growth slows and prices continue to rise. Demand is cooling, but activity is also being held back by labour shortages and material shortages owing to ongoing supply chain issues. As a result, prices are being pushed higher, which is causing concern at the BOE, who now see inflation rising above 4% by the end of the year. So as a result, do keep an eye on the GB pound and of course the FTSE. And results due out on Tuesday include the bakery group Greggs. Now, Greggs reported solid first half results with pre-tax profits coming in at £55.5 million, beating pre-pandemic levels. More bricks and mortar stores, with 48 open so far this year and another 52 in the pipeline, plus an improved online offering as delivery now accounts for 8.5% of sales. This has lifted total sales back to pre-COVID levels. Full-year profits are also expected to come in higher than initially guided. Now, the one unknown for this quarter is, of course, cost inflation. Food input inflation was on the rise 3 months ago. However, labour shortages and supply chain disruption have been well reported across the UK, so inflationary pressures could well have risen further. The share price hit an all-time high in August and has eased lower since. Over in the US, PepsiCo impressed with its Q2 numbers back in July. Net sales rose over 20% to $19.22 billion as on-trade picked up amid the reopening of bars and restaurants. And this is often the side of the business which boasts higher margins. Profits also surged to $2.36 billion or $1.72 per share. The firm raised guidance for the year and shares hit a record high in August. Now, the move higher came on the back of PepsiCo saying that it agreed to sell Tropicana and Naked Juices brands for $3.3 billion to PAI Partners, a private equity firm. And this appears to be part of the firm's pivot away from sugary drinks towards the lower calories area of the drinks market. Earnings per share expected at $1.37. And just a reminder that we have a really powerful app that's absolutely free for you to download and use. The Atlantic app gives you all sorts of useful functionality for the investor, including various powerful live alerts, as well as the latest markets and economic news as it happens. So, why not, after the video, just dial into your app store and download the Atlantic Capital Markets app. It's a really great tool. So, on Wednesday, TESCO is due to report results that are expected to show that it has weathered the worst of the ongoing HGV and labour market crisis. TESCO could well have avoided serious levels of disruption seen in competitors as it upped pay rates for drivers and offered bonuses to new recruits. The big question is whether TESCO has been able to keep driving sales higher in Q2, particularly online sales, given the amount of investment it's made into a digital expansion. Revenue for the half year is expected to come in around £30.4 billion. That's compared to £26.7 billion a year ago, with profits of £551 million. Since July, the share price has rallied 10%. And also on Wednesday, we'll be hearing from Imperial Brands. Now, Imperial Brands is facing several headwinds. First and foremost, the decline, of course, in cigarette smokers. However, there are also currency headwinds and rising tax obligations, which now also appear on the list. The reopening of international travel is likely to boost duty-free airport sales. The performance of cigars in the USA will be closely monitored, given the strength performance in H1. Whilst this could be down to improving supply chain issues, another round of upbeat numbers could indicate whether the trend is likely to continue. Next generation products are also under the spotlight amidst ongoing investment into the sector. Finally, net debt will be watched, given that management has said that they will pass more cash on to investors once net debt falls below 2 to 2.5 times cash profit. And on Friday, we'll hear from Carnival. Now, to say that the cruise ship industry has had a terrible 18 months would, of course, be an understatement. The firm reported a first quarter loss of $1.95 billion, as cruise holidays remained firmly off the list. Even more disappointingly, the resumption of normal service has been repeatedly pushed back. There are, of course, some encouraging signs. For example, bookings were 90% higher in Q1 than in Q4 of last year. And more encouragingly still, bookings for 2022 were already ahead of those in 2019, which itself was a strong year. Whilst the loss was also reported in Q2, Q3 could well see a significant improvement as cruises kicked off again across the summer. Carnival is looking to have around 50% of the fleet sailing by the end of October. And this aim was repeated just last month. Losses are expected to remain around $2 billion, with the potential to rise higher owing to the costs associated with restarting operations. And finally, on Friday, we'll get the latest US non-farm payroll figures. August payrolls saw a sharp slowdown to 235,000 new jobs added. There was an upward revision to July numbers to over 1 million, but even so, August figures served to push back expectations that the Fed would move sooner to taper those bond purchases. Meanwhile, the unemployment rate dipped to 5.2% and yearly wages increased to 4.3%. However, the rise in Delta variant meant that the service sector was badly hit. However, as emergency unemployment benefits ended on 6th of September, the September jobs report is expected to be significantly stronger than in August. Expectations are for 510,000 new jobs to have been created. Fed Powell indicated that semi-decent NFP numbers wouldn't hold back tapering. Now, what remains unclear, though, is what the Fed's definition is of semi-decent. So, to wrap up, let's take a look at the dividends for this week. In the FTSE 100, we'll be hearing from DS Smith, Taylor Wimpey and Kingfisher. In the FTSE 250, we'll hear from Weir Group, Spectris, Bodycote, Morgan Sindall, Vistry Group, Murray International Trust, FC&C Investment Trust and Synthoma. So that's what's to look out for this coming week. And don't forget to look out for our rundown every Friday morning, where we take a look at what's happened in the markets over the week with our own thoughts and analysis. Also, don't forget to check out that app, which you can download from the App Store to your mobile phone, which gives you a whole host of useful functionality, including, of course, the latest financial news, as well as monitoring your open positions. So until Friday, from all of us here at Atlantic Capital Markets, have yourself a great week.